Investors are willing to give up about 0.1% of firm value just to have the right to vote. Of course, I mean, these figures might not sound that big, but if you think about a multi-billion-dollar company, 0.1%, it's still lots and lots of pounds. Even though we cannot directly observe what institutions are doing, what happens is that we do know that in this market for borrowing and lending shares, institutions are the big lenders, and they usually comprise about 80 or 90% of shareholdings, at least in the United States, which is the focus of our research. What we actually find is that right around the voting record dates, so that's the date by which shareholders are registered to vote, we find a big decrease in the supply of shares available to borrow. And exactly because institutions are the big players in this market, we can infer that most of this recalling of shares is actually made by them. There is something that is quite strange, at least in my opinion, in terms of the timing of those events. Of course, by the time everyone shows up to vote on the meeting date, they will have all of the information that they need about what's going to be in the ballot. However, there is usually a period of time, which on average is about 45 days, by which the registrar have to essentially tally who owns shares in the company. And often by that time, investors are usually unaware about what's actually going to be put up for a vote at the actual meeting date. If we think about the big corporate events, of course investors know what's going to be there and they can decide whether to keep on lending or not. But often there are lots and lots of proposals for which that's not the case. So there is nothing illegal or unlawful with this. But definitely there could be more transparency at this time of the record date, such that investors can really know whether it's in the best interest of their investors to recall their shares to exercise their voting rights, or just to keep on lending those shares such that they keep earning the fees. Remember that when we talk about institutions, essentially their ultimate owners are their underlying investors, and that goes from, well, retired people, well, myself with my savings, probably yourself, and so on. So at the end of the day, when they're thinking about profit, they should think in terms of the trade-off between the short-term fees that they could let go by asking for their shares back, and the value of exercising their voting rights, thinking about the long-term profitability of the company. Suppose, for example, that management is thinking about implementing a proposal that would be really nice for them. So, for example, suppose that they want to get a nice box to watch Manchester United play and socialize with their clients. Well, I'm sure that that's very nice for them, but often the expenses associated with this are coming out of shareholders' pockets. So if they want to exercise their vote and say, no, we don't think that this is going to help us out, that means that they are valuing this vote by a little bit. And that's exactly what we try to do in the research. We try to look at what's happening with the lending fees around those big votes as a way to back out how much they value their voting rights. Especially after the financial crisis, there has been lots and lots of regulatory changes exactly trying to improve financial markets. So the SEC, which is the financial regulator in the United States, they have implemented a bunch of measures to change the way proxy voting takes place. The main idea here is that by making this whole process more transparent and giving information to investors, they can make better decisions that should keep managers on top. And one of the biggest changes is something that is called the say on pay, which essentially allow shareholders to vote about the compensation of management, and whatever their opinion or their final recommendation is, it's going to be binding. Here in the UK, what actually happens is that shareholder decisions on pay, they actually are binding in terms of what management can do. So in the past couple of years, we have really observed an increase in shareholder activism, in the sense that often when companies weren't doing so well and their profits were going down, shareholders turned down big bonuses and payments to managers, which at the end of the day is good for society and for shareholders in general, because they should only be paying for good performance. If we have companies that are losing money, well, if we don't fire management, at least they shouldn't be getting any bonuses for not doing their job.